Don't be that guy that came late to the party and everything he want to hear is about how central banking is going to save children from poverty. Unless you are totally loaded already, or you are ginger, as nobody would tell you, play with you anyway. But jokes aside, there is an asset class we also talked about yesterday that is right around the corner of a possible rally. If you want to know more about this, keep watching and subscribe to the channel if you haven't done it so far. As a reminder, we are live, so if you have any questions regarding economy, about trading, so on and so forth, just you may put it right here, right now. As you can find, there is a black box below the window I am attached at. So without any further ado, let's get into episode. Okie dokie, we are starting with economy view and getting over to what about 25 basis points? See, I know majority of the market participants is betting on 25 basis points as we just look through the CME uh, contracts for interest rates. And what I do find right now is after yesterday's meeting, I have reassured. With Mr. Jeremy Powell, that was the meeting where he once again admitted that price stability is the bedrock of a healthy economy and provides the public with immeasurable benefits over time. But restoring price stability when inflation is high can require measures that are not popular in the short term as we raise interest rates to slow the economy. So, what does that mean? So they are aware of that they are unfortunately slowing down the economy by hiking interest rates, but they are not charged of taking care of GDP. They only take care as the Fed's mandate leads to this that they need to care just about price stability, so about inflationary gauges alongside labor market. So right now labor market is strong. They have a room for interest rate hike, and the market or the economy hasn't collapsed that far that they won't get it even worse. That's why I don't find and also share the point of view of BlackRock and also Fidelity that warned that markets are underestimating inflation again. So for me, 25, 25 basis points is a little bit too low, but it as tomorrow we'll go through inflationary gauges, we will know for sure. If it get much better, possibly that interest rate hike may even get lower to 25, as we do know that GDP is also something that US needs to take care of, to not get taken over by China. What other Fed's members are telling Bowman that this year has no voting power, said also that for now, I expect that once we achieve a sufficiently restrictive federal funds rate, it will need to remain at the level for some time in order to restore price stability. And he finds that Fed would maintain with its hiked interest rate level for longer. So listen, Fed hasn't anticipated with price and interest rate hikes that long to instantly get away off the track when the environment at the very recent time started to dwindle. So I would say that Fed's most important asset is credibility. If we just find out what happened in the 70s, let me change the windows once again. Just have a look at this one. Back right then, Fed did loosen the markets, the interest rate back then, and that's what happened. The markets were wandering in the desert for 12 years, and Fed desperately don't want to repeat that scenario. So Mr. Bostic and Mrs. Daly said that those above 5% gauges will stay with us for longer, alongside with Jamie Dimon that says that there is even 50% chance that the central bank will have to go to 6%. Let me know what do you think about it in the comments. All the chat, share your point of view on the chat. But tomorrow we are going through CPI gauges, and there is somewhat like a prognosis table for traders, investors, JP Morgan's game plan on CPI day. As I extend the window, the bank's trading desk sees higher odds of stocks rising. If it gets below 6.4, we do expect, or rather JP Morgan expects, that stocks will thrive, and S&P 500 reaction will be up 3 to 3.5%. If it gets above 6.6%, it will get down by 2.5% to 3%. So those of you that are more advanced, more pro in investing, trading, may find it's a very interesting time to enter the market where this volatility will kicks in. But otherwise, I wouldn't make any bets if it's in such a shaky environment. There is very difficult to really assess whether the market finding the specific of the gauge as bullish or bearish when it's just the JP Morgan's view, but it's not JP Morgan's, it's not the majority of the market. That's why it's just the one player. Just so be cautious regarding this. Yeah, it might be true, it may happen, and it's quite not noticeable to take that stance, but always remind that it's just a narration, all right? So first, there is a widely watched US inflation data are likely to come in cooler than expected, helping stocks possibly to extend a rally, bear market rally, if I want to call it so. Okay, but let me know in the chat what's your positioning. Are you in the game or off of it tomorrow at CPIs, for instance, on US 100? But we are heading further. Market outlook and what we have out there. I would like to get you through chart that right now is very interesting. Yes, Europe is thriving, but it's just the one that I wanted to show you. As we are right now in a decisive mode, whether we are about to get to new highs or it's just a fake rally, and afterwards we'll have another slide downwards. But with such a price action, it's normally a post bear market rally, so it's more likely that we'll have maybe another highs this year. So as many market analysts find that this calls about the recession in Europe has been outdated, but it was Europe. And right now, let's have a look at what's happening with DXY. We are getting closer and closer, all right? So I wouldn't be so sure that many of the indexes will rally when DXY may rebound imminent. Okay, so that was it. Right now, let's have a look at kind of a comparison. So recently, we've been through. This is a ratio of growth stocks to value stocks, and as you can find, it was a really decade for growth stocks, as we had an era of very cheap money, and as we do know that cheap money favors growth. But what will happen next? There is a prediction of Bank of America that we may have a slump to the levels of parity between value and growth. But I would say that right now, maybe this another metrics showcases it's in a proper way throughout recent years, throughout previous century, where value stocks were dominated. You know, there were Coca-Cola company, there were many banks that were favoring and prevailing in terms of market capitalization. But this 20 years, this recent 20 years is strictly different, as this Nasdaq is getting bigger and bigger in market size. So we are literally switching into a virtual world, and I do not expect a revert from this. As we do know, at the growth stocks expectations for companies to deliver on ambitious plans make growth stocks risky. If those plans don't pan out, share prices are declining. But as we do know, during the time like this, as of recent 15 to 20 years, we have literally switched our habits in terms of spending more time in a virtual world, whether it's web, whether it's smartphones, and it's only getting bigger. So I do find that this value stock, this higher return of value stock, is rather an one of the odd year during the recent span of predominantly prevailing growth stocks. So besides recent year, I would expect that growth stocks will have its another decade, even with maybe that era of easy money will end to some extent. But I don't expect that will happen to such of a large difference. Right now, I would like to show you Another chart is also very interesting, and for this one, I want you to switch over to Outlook, and I have for you 1 second. It's somewhere here. Oh, too many assets. Okay, getting closer. Yes, Nasdaq to SPX. In this ratio, it looks better. So it may be kind of a choppy sideways movement to take place around the levels of 2.73, but I do expect that this rally forward and this ratio, Nasdaq to SPX, will continue rally forward. Yes, I do know that at SPX there are not only value stocks, but I would say Nasdaq is mainly steered by those growth, and SPX is mainly steered by those of value. And that's why this ratio seems I would say decently juxtaposed. All right. So that was Nasdaq to SPX. Also very interesting chart I want to show you, but maybe a bit later. So we'll get back to this yet. So we are getting back lost years for growth. I don't think so, but let me know in the chat what do you think about it. Crypto outlook. Yes, that's what I meant about the possible rally forward. What I do think like that volumes getting powerful. How to comprehend this when volumes has literally recently weakened to the yearly lows. So descending volume bars after exceptionally large volume sell-offs are indicative for market bottoms. That's what technical side says. And for this one, let's have a look right here at the Bitcoin chart. It's Bitcoin, and as you can find right here on a weekly chart, maybe I will turn off any drawings to make it more clear. And as you can find, we had major sell-off on this FTX calamity, and right now we are at the descending volume. So it means literally that this polarity on the chart starts to take a pivotal role. So it's very interesting to watch how it will play out. But if you are taking much of a more cautious position on the market, just wait for the break of 21.2 thousand. That's also what's happening on Ethereum chart. The Ethereum, sorry, not this. The Ethereum, we also have a collapse of trading volume, so it means it might be very interesting indeed. But we'll get back to this also a bit later. Also, market doesn't react in change in price for negative press news. Seems exhausted by selling pressure. Just have a look at this one. Coinbase layoffs has been harbinger, and Coinbase eliminates 950 staff, or 20% of workforce, in latest round of layoffs. So it looks like even with such over data, we still finding out that the Bitcoin holds very well. Also, Coinbase closing most of Japan operations, scaling back in Japan even as the nation loses some crypto rules, which has spurred rival Binance, the largest digital to seek a license to return to the country. And he added that several projects with a lower probability of success will be shut down. That's what Brian Armstrong, CEO of Coinbase, said. And surprisingly, Ethereum make uh, hasn't even made any mm, move, and it looks like this price action may be beginning of something more serious. Also, elusive catastrophic scenario is that about this Mt. Gox. So back on August of 2029, rumors of a massive Bitcoin dump from Mt. Gox circulated on social media. However, creditors of this defunct, I would say, or forever trading platform dismissed the rumors and said that they are still unable to register where they can receive the funds out to them by Mt. Gox. So there's another calamity due to the fact of Mt. Gox redemptions that is getting elusive scenario with that procedure being once again postponed. Notwithstanding the subject is being rolled over that many times that it's with high probability and with high odds and of already being discounted by current prices. So that's what I do expect. Also, where it was a was it a poll or survey back in October that majority, a remarkable majority of those those victims of Mt. Gox wouldn't like to sell a Bitcoin on the market as it's low valuations right now. So it looks like this Mt. Gox theft has gathered smart crypto money, as they do know that it's rather low valuations to buy rather than sell. So it's very interesting how it play out. But also with Ethereum's expectation with withdrawals happening from Beacon chain happening on March alongside Bitcoin will be very interesting to find out how it play out. But the March of this year looks like it may be the where the dip will get eventually marked. So very very interesting times indeed ahead. What we got next? Market movers. So market movers during this hectic week is something we need to discuss. What we got at economic calendar on Wednesday. Oh, maybe. Yes. So on Tuesday, we had Fed Chair Powell speech. I've already told you over this one. Monthly CPI indicator of Australia seems to be as forecast, with a lowering, slightly lowering tendency. So it's positive for the market. And today, inflation rate of China. So it's also interesting to watch, as and the market is afraid of getting of this audacious 2%, really atrocious notch. So inflation rate will be definitely the one that the market will watch from China, but obviously the one that may shake the bears, may shake the bulls, is inflation rate of US. So that's most important for tomorrow. And right now, as it's earnings calendar coming up, let's have a look. So upcoming earnings season may turn the sentiment around. Companies in the S&P 500 are expected to post a 2.7% profit decline in the fourth quarter. That's what survey shows. Oh, that's pesky ads. So definitely the banks will set the scene, but on Thursday we also have TSM, Taiwan Semiconductor, to find out. As we know, the market cap of TSM is even larger than United Health and JP Morgan. So it's kind of a behemoth that we'll be watching. But we are getting and sticking to our knitting and heading to the next and last session for today. That's trade idea. So what we got out there for this one, once again I will jump to the markets and to the trading. So right here you have a natural gas, all right? So a natural gas is in a very important spot right now. On a daily chart, we've aligned with a November of 2020's high, and after grabbing liquidity of those lows, we would find that that's the possible last stop during this bear rally and this leg downwards. So as a background and fundamental elements, there are still almost 3 full heating months ahead of us. So it's January, February, March, and depends on the region. It's April. So a significant drop in demand for gas is visible at normally beginning of March. So that what happened back then in 2021. So we had a slump in December right after recovery by March, and then rally forward. So we've been observing an anomaly in the form of increase in the filling of warehouses for about recent couple weeks. Assuming the average consumption from previous years, Europe, if we just get to Europe, Europe will end the heating season with 48% of filling. But in order to possibly start another decrease in prices, this filling would need to get us to 60%. That's what analysts assume. So we still have a chance to increase our filling warehouses, and that's why I do expect that even fundamentally, either fundamentally or technically, we have a room to rebound. But it's a stop of a last resort, all right? So yesterday we've discovered that what will happen right here will be decisive for the next price action. And right now, as we are rebounding on a strictly low volume, but marking the local bottom, that's a good for the market, as we have a chance of further move upwards, especially with as we are right now observing overtaking recent highs of 10th of January. So it's a positive for the natural gas. even with this slide, as we do know that natural gas likes to make such deep slides. Sorry. So only for our interval. Sorry, I need to keep some water. Sorry for my throat. Um, right here on a 4-hour chart, we can find a exhaustion candle. So it's normally a sign of a possible reversal, especially at such a of an important levels. So in terms of possible trade idea, right now we may be catching this knife, as we do know that after getting out of this highs, we are more likely to rather continue the rally forward rather than downward. So in terms of this trade, I do expect that natural gas yes, it's 0.6, 0.7. Yes, so it's a Fibonacci extension level of 0.78, and normally after corrections, natural gas stops at this type of level, so making its corrections highly deep, and it might be a very good time to enter the market before the US Open, as it may push the price forward. So in terms of target, the first one target is for natural gas at this type of high, but I do expect that we'll get to at first to this downward line that will may cross even forward, but as a first stop, it will be very nice spot to take profits. So as a recap, risk reward ratio at 4.68 and a possible entrance around this level within a blue box will be the most satisfactory for me. Always remember about adjusting risk reward ratio regarding where you took your entrance, and enjoy the proposition. Always remember about assessing the risk and the size of a bet or of a trade regardingly. So that's it in today's episode. Thank you very much for watching. I was very glad having a chance of hosting you here. Thanks, and see you tomorrow at 8:45 a.m. Bye bye.